Hi friends, my name is Krishna. Welcome back to my YouTube channel. Today's topic is going to be on intercompany accounting. We are going to talk about what is intercompany, what is transfer pricing, and intercompany settlements, intercompany disputes. We are going to talk about all these topics. It may not be fit into one video. Probably I need to take maybe 2 to 3 videos. Please bear with me for that. Okay, let us talk about what is intercompany accounting. Let me read out the definition. Intercompany accounting talks about financial activity that takes place between two subsidiaries or between the parent and a subsidiary. This is what intercompany meaning says. Let us say, I'll explain this with an example. Okay, let us say I started a company called X Limited manufacturing unit in Bangalore. I started a manufacturing unit called X Limited in Bangalore. Now, I wanted to sell my products on my own in different states. Let us say I wanted to sell my business in Karnataka, Tamil Nadu, Telangana, Maharashtra, let us say. Okay? So, I started one entity in A entity in Karnataka, B entity in Tamil Nadu, C entity in Telangana, D entity in Maharashtra. What did I do? I started a manufacturing unit of X Limited in Bangalore, and whatever products this X company, X Limited, is going to manufacture, that will be sold by X company on its own in Karnataka, Tamil Nadu, Telangana, Maharashtra, and so on in different states. How does how do we make sure that these products can be sold by keeping the entity in Bangalore, manufacturing entity in Bangalore? We need to have an entity in different business units in different states. So Karnataka, I started one organization, one business unit called A company. This A company buys product from X company and sell it to the retailers. Similar way, B company will buy the material from X Limited and sell them to the retailers. Similar way in Telangana, C company limited, it will buy products from X Limited and sell it to the product. Similar way in Maharashtra, D company limited will buy products from X Limited and sell them in Maharashtra. So I started different units. I, in the sense, X Limited started these entities, right? So who is owning the capital in these A, B, C, D entities? What X company did is, X company provided capital to A, provided capital to B, provided capital to C, provided capital to D. X Limited invested capital in A, B, C, D entities. So what does it mean? A company, B company, C company and D company are created by whom? X Limited. Who invested in A, B, C, D companies? X company invested in A, B, C, D companies. Right? So, these companies, A, B, C, D companies, are called subsidiary companies, and X company is called as parent company. X company is called parent company because that is a major a company where who invested in A, B, C, D, right? So A is called subsidiary, B is also called subsidiary company, C is also called subsidiary company, D is also called subsidiary company of X Limited. Clear? Now, what definition says once again? Intercompany accounting talks about financial activity that takes place between two subsidiaries or between a parent company and subsidiaries is called an intercompany accounting. So, whatever financial activities happens between X and A, X and B, X and C, X and D, that means parent company versus subsidiary companies is an accounting, intercompany accounting. Similar way, in case if there are any financial transactions happens between A and B, between B and C, between C and D or A and D or A and C, those transactions are also called intercompany accounting. So, what the definition says? Intercompany accounting talks about financial activity that takes place between subsidiaries, between A, B or BC or AC or BD or AD. These are the subsidiaries, between subsidiary companies, or between a parent company and subsidiary companies is known as intercompany activity or intercompany. It is called intercompany activity and that has to be accounted, right? So when we account those activities, that is called intercompany accounting. Clear? Now, what we need to understand here is, when do we call X Limited as a parent company? When do we call A, B, C, D as subsidiary companies? That is something which we need to understand. Number two, what are those financial activities happens between these parent and subsidiary companies? X can sell the goods to A, X can sell goods to B, X can sell goods to C, X can sell goods to D. Not only goods, X can sell services also to these companies. X can transfer assets. X can sell the services to these companies. There can be a royalty transactions between these companies. X can allocate the expenditure between these companies. For example, I was referring in fixed assets. Suppose X started one manufacturing or creating one software which will facilitate the financial activities between these companies, and they incurred around $1 lakh for creating that software. That cost X Limited alone need not pay because the software is going to be used by A, B, C, D as well. So that expenditure can be allocated between A, B, C, D. We will talk about all those things later. I just wanted to let you know what are those transactions happens between these companies. X can finance these entities. X can give loans to these companies. Subsidiaries can give loans to parent companies. Anything can happen. So whatever financial activities happens between parent company and subsidiaries or within subsidiaries will be called as intercompany activities, and when we start accounting them, we call it as intercompany accounting. Are you clear? Right. Who is parent company here? The definition is very clear. A parent company is a company that owns more than 50% of the voting shares of another company. That means what? X Limited, when do we call it as X Limited as a parent company? X Limited will be called as a parent company provided X company has more than 50% of voting shares in each subsidiary. Each subsidiary parent company should have more than 50% of voting shares. That means more than 50% of the capital would have been invested by X Limited. Then only X Limited will be called as parent company. Clear? Then, what do you mean by subsidiary company? A subsidiary company, also known as daughter company, is controlled by a parent company or a holding company. These subsidiary companies are holded by whom? These subsidiary companies are holded by a parent company. Right? So, whatever capital invested by X Limited in different subsidiaries And if the holding is more than 50%, then X Limited will be called as parent company and ABCD companies are called subsidiaries of X company. Clear? And this parent company is also called as holding company. What is the difference between a parent company and a holding company? Parent company and holding company virtually one are the same, but the slight difference is mentioned here. Parent company often oversees their own business ventures and focus their acquisitions and they help subsidiaries as well in their business. Parent companies, what they do? They help these subsidiary companies. They oversees their business. They help them when they are in need. But holding companies are relatively inactive with their subsidiaries. Holding companies, they generally don't get into the business of subsidiaries. They invest and keep quiet. They are inactive in terms of managing the operations of subsidiaries. So that is a slight difference between a parent company and a holding company. Clear? Now, when the transactions happens, for example, X Company Limited manufactured a product called F. X Company is manufacturing a product called F. This F product is available in the market because X is selling in the market. So what X company is doing, it is manufacturing the product called F and transferring that product to A, B, C and D. Why it is transferring that F product to A, B, C, D? Because X created these A, B, C, D companies with the intention to sell this F product in the market by these subsidiaries. So the main intention of these subsidiaries is these subsidiaries will take the F product from X Limited and sell them in the market. That is the intention of these subsidiaries. Now the question is, when the F product is manufactured by X and sent them to A, at what price this product has to be sent to A? At what price X has to send this F product to B? At what price this F product has to be sent to C? At what price this F product has to be sent to entity D? X has to send this product to those subsidiaries, right? At what price? That price is called transfer pricing. The price at which X Limited is going to send the products to their respective subsidiaries is called transfer pricing. What do you mean by transfer pricing? How this transfer pricing is going to help us, we are going to learn now. Okay? Very, very important, guys, because in most of the interviews when we get into R2R process, your interviewer is going to ask, what do you mean by transfer pricing? How do you calculate transfer pricing? So you need to face these questions there, right? So focus on this. You will be in a position to learn this. What is transfer pricing? As I said, whatever be the product transferred by X Limited to A, B, C, D at a specified price, that specified price is called transfer pricing. What did I say? X Limited is manufacturing a product called F and it is sending them to A, B, C, D. These are the subsidiaries. A, B, C, D are the subsidiaries. This F product is being sent by X Limited to A, B, C, D and asking them to sell in the market. Let us say F product manufacturing cost is 80 rupees. X Limited spent 80 rupees for manufacturing F product, right? So if the product manufacturing cost is 80 rupees, X Limited cannot send this product to A with 80 rupees, or B with 80 rupees, C with 80 rupees, or D with 80 rupees. If X is sending only with 80 rupees at the cost, then what is the profit for X Limited? Right? So X Limited has to transfer this product to respective subsidiaries by charging some margin, by keeping some profit on top of 80 rupees, $80, right? So that price has to be decided by X Limited before transferring that product to the subsidiaries. This transfer pricing will be calculated in 3 different models. One is market-based transfer pricing. What do you mean by market-based transfer pricing? 80 rupees is the manufacturing cost of a product. In market, it is available for 100. In market, this F product is available for 100 rupees. That means what? Market price is 100 rupees. So X can send that product to A for 100 rupees, B for 100 rupees, C for 100 rupees, and D for 100 rupees. That is called market-based transfer price. That means whatever price available in the market, X is selling with the same price to their respective subsidiaries. Second one, cost-based transfer price. What is the cost of this F product? 80 rupees. If it sends 80 rupees to ABCD, X will not get any margin. So what X Limited will do, 80 rupees cost plus they will charge. Maybe 10%. This is called cost plus model. This is called cost plus model. What does it mean? 80 rupees is the cost for X Limited, plus it will charge 10% margin on it. 10% on 80 is 8 rupees. That means what? X is going to transfer this product to A, B, C, D at 88 rupees. This is cost plus model, cost based model. The cost of the producing F product is 80 rupees plus margin has been charged, 10% margin. 10% is not fixed. I'm just giving an example. It can be 7%, it can be 15%, or it can be 20%. It all depends. That is called cost based transfer price. Other one is negotiated transfer price. X Limited can negotiate with A, B, C, D and see what is the agreed price for them. It can negotiate with ABCD. For example, in Karnataka, the agent A company said, I can sell this product for 120 rupees. If you want to charge 20%, you can charge 20%. And B person, in Tamil Nadu, he said, I'm sorry, I cannot send it for 120 rupees in Tamil Nadu, so I can send only for 110. So please don't charge 20%. So accordingly, it will go and have discussions with all the subsidiaries, negotiate and come to a conclusion at what percentage it has to charge, and it will negotiate accordingly. The percentage will be charged on the cost and send that product with the respective price. That is called negotiable transfer price. So there are 3 models: market-based transfer price, cost-based transfer price, and negotiated transfer price. These are the 3 different prices at which X Limited can transfer the price to different companies. I'm stopping here, guys, because it is becoming almost 20 minutes now. So I'm going to talk about the transfer pricing, rest of the part of transfer pricing, how the transfer pricing will be calculated, what is the formula says, and and other topics as well in my next video. Please bear with me for another 1 or 2 videos to complete this intercompany accounting. And if you like this content, please like the video and subscribe to my channel, and also share this video with your friends and colleagues, right? Thank you so much.